CNBC-TV18.
Inflation is easing, the stock market is soaring, the Sensex and the Nifty at their highest level in 13 months. Bank stocks lead the charge. 4 weeks of gains for the Lal Street. What next? Hello and welcome to Editors Roundtable. I'm Reema Tendulkar. With me is Prashant Nair, Anuj Singhal and Nimesh Shah. Hello, boys.
Hello, and
what a week, right?
What a week, and what a way to end it, actually. And the way the US market sort of gave a bit of a false alarm, and after that, that massive breakout, almost everything going for us. Dollar index 108, bond yields crashing, whatever could go right for the market gone right. HDFC Bank, coming back to life on Friday. So much happened over the weekend, despite it being a truncated week, actually.
And this just underscores the...
Maybe this week was that we lost out in the semi-finals, and back to that badly. So I think that was the only story point.
Made up with the Friday rally. I mean, somewhat, right? Not fully. Anuj, you were awake for the last big overnight session.
This time I was not. This time I was not. This time I was not. I think once is enough, Prashant. At 42, I think you have to plan these, You can't be awake for everything.
But it just underscores the importance of staying invested in the market, right? Because days like these, 5.5% on S&P, 7% on Nasdaq, come out of nowhere.
Yeah. And a 20 basis point, actually, if you think about it, it's a 20-25 basis point miss to CPI inflation.
Exactly.
A 20 basis point miss in inflation leading to a near 7-8% rally in the Nasdaq and 5-5.5% of the S. These are not some faraway emerging markets. The largest, most liquid market in the world. It's amazing.
The fall was also like that. It's almost like a spring which has been roiled and it's just about to release the energy, and you give it. But I think, Prashant, I take your point on the inflation. I think the markets assume that this is it, and that Mr. Powell has won that battle. Yeah. What if next month it comes back and raises its ugly head? So I don't know, but every month is different.
But if you see a lot of global indicators, the technical indicators in the US. Are suggesting a rally from here. Post the midterm elections, normally see a 18-20% rally in the S&P. Post Nasdaq rallying, in one day 7-8%. You see a big move in the Nasdaq as well. So those, the technical, all the parameters are suggesting a bit of upside in the global markets. So maybe that will help us.
Nimesh, they say that the largest moves, and we've all seen enough markets, largest moves happen in vicious bear markets, right? The biggest of the moves. One just hopes that, as you said, the next month inflation numbers are well behaved and they're not an ugly surprise.
Yeah, and the scared bear is the biggest bull, right?
So the biggest bull.
And the bear got scared a bit, so maybe that also.
But let's talk about the global setup, right?
Yeah, no, absolutely, Reema. I'm going to walk across to the wall because the global setup is really the sort of big thing this time. And I'll tell you why, right? As I said, the topic is when good news is simply good news. I'll tell you why. All of this year, how many times have you heard the phrase good news is bad news, which is data is positive, which means that Fed will tighten. So good news is bad news. And bad news, bad data is good news, which is, labor market data is weaker, claims data is higher, which means economy is slowing and, Fed will loosen, which is bad data is good news. But this time, for the first time this year, I think we can say good is actually good. Good news is good news unambiguously. And the moves are massive. Even those who watch markets for 15, 20 years, these are moves which you don't see very often. This is the rates market in the US, the most liquid market in the world. The 2-year, the 5-year, the 10-year, 30-year, we saw 25 to almost 30 basis point falls across tenors. In percentage basis, this is across the board 6% fall in the US government bond yield curve. That is massive. Let me tell you how massive this is. If you go back all the way to 1980s, there are only 5 instances, if we can move on, there are only 5 instances of the US 2-year yield falling by at least 20 basis points from a 200-day high in the prior 10 days. Let me explain this. If the 2-year yield is at a 200-day high, there have been only 5 instances that, within 10 days of that high, the 2-year US government bond yield has fallen over 20 basis points. And what happened last night was one of those instances. This is 1987, 88, 90, 2022, which is the FOMC. Of course, the market bottomed around there. and then yesterday, which is the 10th of November. So, I mean, the magnitude of the moves, absolutely. Will the moves last is the question. And for this, I mean, you know, the sample size is small, just 4 instances. So one cannot make sweeping statements, but we work with what we have. And I just looked at 2 things, dollar index and the 2-year yield, rates and dollar. These are the 2 most important channels via which global financial stress seeps into the market here. It pressures the rupee, it pressures deficit and things like that. What happened in the 4 instances last time is that the dollar index was down another 4% over the next 2 months, right? When this happened, and the 2-year yield bottomed out only after 2 months. So this 2 month is common, which means that for the next 2 months, if you go with the last 4 instances, maybe we'll have a little bit of stability. We won't have ugly surprises. But as I said, you only have 4 instances. That's how rare this move last night was. I'll leave you with a bit of a word of caution, which is, I think, also necessary. This is Citi's economist who says, and I quote, markets continue to overestimate the likelihood that some version of the risk-positive, transitory inflation, Fed pivot, soft landing narrative will play out. He's saying, well, this is overestimation. The economist from Morgan Stanley saying a stronger than expected December payrolls print could still complicate the issue at margin. And then you have CLSA who acknowledges that the payrolls data was stronger than expected. October CPI, while it is good, but one needs to keep a sense of perspective and not get carried away. So that's basically where some of these guys are at. And I think it's only fair, take the good as good, but also at the margin be a little careful. Back to you guys.
Yeah, you know, and very interesting points Prashant made over there. The other thing actually is that we've seen a lot of ETF inflows into our market because ETF money chases momentum. Now, if you have the kind of momentum that US market started to show yesterday, 7% rally in the Nasdaq, and today all things being told, the Indian markets move actually was a bit disappointing after a gap up. I mean, the mid-cap index actually was in the red. Yeah. So going forward, actually we're nicely decoupling. So you don't want the decoupling on the other side, which is the US as well, and you know we don't do well.
Exactly. Especially
but I
guess so many emerging
what will
markets.
happen is, you know, Anuj, what will happen is maybe within Indian markets we'll see a bit of decoupling. For a longish bit, the mid cap and small cap are outperforming. I guess now it's a time for the large cap leaders to take the leadership role and support the market. So we saw this today, right? The HDFC Twins, Reliance, and Infosys. If you look at those 4 stocks, they added 1,000 points to the Sensex rally of 1,050 points. So if barring those 4 stocks, the Sensex was also flat, so to speak, in today's trade. So 50, there is leadership now back.
50% of the Nifty gains came, 150 index points came from
those 4
HDFC
stocks.
and HDFC
Absolutely.
Bank. Anuj, you're talking about HDFC Bank, right? And how potentially it could gain leadership back.
You know, I'll tell you one more thing, and I'll just go to the big wall. The lopsided nature of the bank Nifty. Talk about contribution. HDFC Bank contributed 800 points in a 500-point Bank Nifty rally. So it tells you what the Bank Nifty was doing, right? But you know what? Just look at what the individual stocks have done in the Bank Nifty and why today could mark a bit of a tectonic shift in HDFC Bank if it does. This is the move that we have seen in the big banks. This is 1-year move and this is 3-year move because, 1 year, it's okay, a stock can eke out outperformance. But when it's a 3-year move, just look at what ICICI Bank has done compared to HDFC Bank. ICICI Bank's 1-year move is 19% and 3-year move is 162%. Look at HDFC Bank. We just keep saying that it's underperformed, it's underperformed. It's underperformed how much? Over a 1-year period, it's up 2%, counting today's rally, by the way. And over a 3-year period, 26%. That's a very big difference, 136% difference. And look at Kotak Mahindra Bank. It's actually fallen over a 1-year period. It's down about 7%, while it's only up about 19% over a 3-year period. Now, I keep saying that Bank Nifty is a very lopsided index. Just look at the Bank Nifty weights, and this actually is a stunning plate. Now, HDFC Bank plus ICICI Bank is 50% of Bank Nifty for longest. But 3 years back, this 50% was divided as 30% for HDFC Bank and 19% for ICICI Bank. Look at what happened now. If we didn't have this rally today, ICICI Bank could well have overtaken HDFC Bank as Nifty's #1 contributor for the first time in history. That didn't happen, and it's now unlikely to happen maybe. But 25.6% for HDFC Bank and 24.6% for ICICI Bank. Axis also has been a bit of an underperformer. Of course, SBI has been quite stable. And look at Kotak Mahindra Bank. It used to have 13% weight. It's now fallen to 10.9%. Now, there's another interesting thing which actually Nimesh told me, and I just looked at the data after that. Look at what HDFC Bank ADR is doing. HDFC Bank ADR used to enjoy a premium over the stock here. Now in May 2022, it started to trade at a discount, which was never heard of. That was the kind of hate that HDFC Bank stock had. Almost everyone was just giving up the HDFC Bank stock. It's currently back to 18% premium, which is indicating that FIs are already buying it via the ADR route. Now, of course, let me give you the news, which is now well documented, what happened today, which is from the brokerage note that we found out that the MSCI has changed the methodology for M&A, and which means that the requirement of minimum foreign room is done away with, which means that potentially HDFC Bank's weight, the twins' weight could actually go up. It could go up to double, and that was the reason that you saw this big rally. So that's the HDFC Bank story. But I tell you what, for me, the dark horse could actually be Kotak Mahindra Bank from here on. And the reason for that is very simple. As I said, it's actually underperformed even HDFC Bank. And FTSE's review is due in March. Now, it missed out in the inclusion in the September semi-annual review because of that time factor. It could not give that shareholding pattern in time. Now, the FI room in stock has opened about 20%. So maybe in the next review, it should get in. And that would mean that a potential inflow of about $1 billion in Kotak Mahindra Bank. The short story is that basically the underperforming banks, remember, Axis Bank has already corrected some of its underperformance. HDFC Bank has started to do it. Maybe it's time for Kotak as well to start correcting that underperformance.
The point is that these are market-weighted indices, right? Yeah. As Anuj also said, because if and it's true for all indices, Bank Nifty, and we often wonder, what does well gets bumped up, it gets a higher ranking. What does not do very well, it kind of is thrown out of the index, but not these stocks. But the point is, these are momentum, market-weighted index. It essentially is a momentum index. And that's why...
the other point is, generally, you've seen historically, in the last 2 months of the year, the underperformance start to outperform. In the sense, the money shifts from outperformers to underperformers within indices, within stocks as well. So maybe it's time for, the underperformers to do a bit of a catch-up. Money will flow into those stocks. Yeah. So generally, there is a rebalancing happening towards the end of the year. And historically, the data suggests that the outperformers tend to underperform in the last 2 months, and the underperforming stock starts to see some bit of momentum, and the money starts chasing them. So even that could be a play factor for the likes of HDFC Twins, Reliance, and all those stocks.
If this rebalancing theory is true, then what about on a global landscape where so many of the emerging markets have underperformed India, and now that things are stabilizing on the global front, you've got a valuation comfort for the emerging markets. What if the FI money actually starts flowing towards there?
Some of that,
and you're seeing that this week as well.
Some of that play out today, for example. China saw that some bit of inflows, Reema. I think Prashant had highlighted this beautifully some time back, that India perhaps is now the only investable market in the BRICS countries, and I think that clearly is something that may play out. I think Naren also told me that China will see one wave of buying. Maybe that happens for sure.
All right, we need to slip into a very short break, but don't go anywhere. On the other side, we'll get you more market opinion. We've got a lot of interesting analysis on the new age tech IPOs, as new age tech companies, as well as the IPOs. Stay tuned.